The real estate market in Canada has changed. My question is, have you changed with it? Today I'm going to show you how to analyze multifamily properties just like this fourplex we own in today's new economy with the new rules, new market, new landlord and tenant board rules, new rents, new expenses, new interest rates, new world. If you can pay attention to this, you'll know how to analyze and find opportunities in the future. Folks, we're back. Let's take a deep dive into the numbers. This fourplex, as you can see right here, cost us 1.2 million Canadian dollars. You might be thinking we're crazy. Maybe we are, but I'm gonna show you how we found tremendous value stuck in this property that nobody else could see. This property was generating $96,000 per year in gross rent, broken down this way. Unit 1, 3-bedroom, $2,500 a month. Unit 3, also a 3-bedroom, identical, $2,500 a month. Unit 2 and Unit 4 are identical 1-bedrooms, producing $1,500 a month. That's $8,000 a month and $96,000 a year times 12. Tenants are paying all the utilities. Now, of course, we have expenses with the property, okay? We applied a vacancy rate of about 2% per year. That's a little bit, about 30% lower than average for the area, but because it's a new property, we expect to get much less vacancy because of the quality of the property. Into the operating expenses, the taxes, property taxes, unavoidable, $7,200 per year. The insurance, $3,200 per year. That covers everything on the property, even sewer backup insurance. I have the utilities, heat, hydro, and water at $0 per year because the tenants are paying all the utilities on top of the rent, okay? Maintenance at $1,200 per year, about $100 a month. I'm averaging out maintenance. Yes, that is low. Feel free to criticize me in the comments, but remember, this is a brand new property, literally built from scratch. The maintenance will be low for the foreseeable future, okay? And management, well, that's a crazy cost for management. Our management cost, I'm gonna show you, is actually zero because we manage this on our own. We have several properties in the area and we have the systems to put it together. But if you needed a property manager, you might wanna add, let's say about, not that much, about 5% per year is a reasonable number, and that's about $5,000 here. But I'm gonna leave it with my numbers here at zero, okay? And I have someone who comes and cuts the grass and shovels the snow in the winter, of course, and that averages out about $100 a month and $1,200 a year. And that's it, okay? Tenants pay electronically, all the maintenance is taken care of, grass, snow, taken care of. We don't have any more expenses. That totals up to $12,800 in expenses. And when you take the gross income, subtract the expenses, you end up with a net income, folks, of $81,280. That's a very, very important number. But I needed to give you that context for a reason. Before we jump into the nitty-gritty and why this is valuable, let me tell you that my wife and I have about 51 rental units across, Ontario. We have a decent sized portfolio, and we've been doing this for over 15 years. Principles we've used to find good investment properties have not changed the entire time. What has changed are the personal investment goals. The foundational principles we've used to analyze good rental properties have not changed the entire time. What has changed is our individual investment goals as our personal lives and family have matured. We've gotten different goals and we use the profits from our properties for different reasons. But when push comes to shove, these type of properties gives us the best bang for our buck in cash flow, in appreciation, and long-term ease of management, because I don't want to burden my life with difficult properties, difficult tenants. I want stuff that's easy to manage and that gives us the profit we need to run our business and live the lives we want to live. Now let's take a look at how we financed this property, because of course we didn't pay for this property in cash. We needed the bank financing to get this property done. I want to show you the details here, and then we're going to jump into the ROI and tell you exactly why it's an awesome deal. So as you can see here, we purchased this property for $1.2 million. That's $600,000 per side. It was two duplexes attached to each other. You could say it's a fourplex, whichever you want to call it. It's the same amount of units. And we put down 20%. We received a mortgage of $960,000 with a 30-year amortization, a 5-year term at 5% interest rate. Now that's higher than we've been used to over the past, let's say, decade, but we still did the deal because the cash flow numbers work. I'm gonna show you that shortly. All in all, the total debt service payment for the year is about $67,000 a year. But what's great is that we earn $81,000 in net income, leaving us a decent amount of cash flow at the end of the year. Before we dive deep into the ROI, there's one piece of the puzzle I haven't talked about that's really important, and that's location. Even if you find a great property with great numbers and great cash flow and you get great financing, if it's in a crappy location, are you really doing yourself any favors? No, you're not, because you're gonna attract bad tenants and you're gonna have a hell of a time renting this place out over the long term. So your location is just as important as everything else. So this location, I'm gonna share with you right here, is in St. Catharines in the Western Hill neighborhood. In the Western Hill neighborhood, and we chose this neighborhood because it's growing, it's gentrifying. There are some older properties that don't look very nice, and there are some newer properties that look amazing. It's gentrifying from an old neighborhood. Young people are coming in and improving it. It's turning from a, as the Americans say, a C neighborhood into a B neighborhood, and that's where you make a fantastic return over a period of time. And on top of that, there is something special here, which I'll show you on the map. Let me zoom in. Right here where it's in blue, where it says St. Catharines, and you see that train in the green GO, that's the St. Catharines GO station at Western Hill. We are literally walking distance from that train station. Now, is that gonna make or break our investment? No. But is it icing on the cake? Absolutely yes, because we now have the added advantage of being able to tell tenants that, hey, you can literally walk to the GO station and be in Toronto in 65 to 70 minutes. That's a big deal for someone who wants to work in Toronto, travel to Toronto, have access to Toronto, even into Niagara Falls. It's a big deal, it's a big advantage, and it's why we were able to rent our property in less than 30 days and get premium rents. So location, my friends, is important. Now, let's dive deeper into the ROI. If you have a good property in a good location and a cash flow, and you got the ROI to work for you, and you got good financing, friends, you have a gem. If you have the money for the down payment, there should be no excuse why you should not buy that property. If you're working with a realtor, especially an investor-focused realtor, and you have an investor-focused team of professionals around you, they're gonna be able to spot problems with the property that come up with inspection, or a foundation, with zoning, some of the things that we can't talk about in a video like this. So make sure you have a team of professionals to help you. How did this property break down in terms of ROI? Well, we're getting a cash on cash return of 5.3%. Now, what is a cash on cash return? What that means is our net income for the year is $13,935. If I take that net income for the year, the net cash flow, and divide it against my total down payment, including closing costs, of $264,000, that means I'm getting a basic cash on cash return of 5.3%. Now, that's not amazing, that's not something to write home about, but in our market, that's pretty good. And if interest rates should decline, which they are declining, that cash flow is going to increase because I'm going to pay less and less interest for the debt service, and my cash on cash return will eventually increase. But for now, it's 5.3%. I'm also getting a return called principal recapture. Okay, that's another way of saying that every month that I collect rent, some of that rent, or all of that rent, is going toward paying the mortgage, and some of that mortgage payment is principal pay down. So I'm getting the tenant's rent payment, and I'm paying down my mortgage a little bit every single month, and I get a return on that because it's not my money paying for it, right? So that's a total return of about 12% a year. Now, 12% isn't anything amazing either, but when you factor in 12 plus 5, I'm already at 17% a year. Now, how many of your GICs, mutual funds, stocks, or bonds get you a very consistent and easy return of 17% a year? Not many. This is why real estate is so powerful. And I've now added appreciation. Properties do appreciate over a period of time. Yes, year to year, things can change. Properties can go up, properties can come down. But if you take a line graph over the last 5, the last 10, the last 20, 30, 40, 50 years in Canada, or basically anywhere in North America, you will see that properties do appreciate. Now, I've been very conservative, and I've put an appreciation rate of just 2% per year, not even 3 or 4 or 5, but 2% a year. And that gives me another ROI of 9%. So my 17 plus 9 gives me a total ROI of 26% per year. That means in 4 years, in terms of appreciation, principal pay down, and cash flow, I should recover my entire amount of my down payment. Now, let me ask you a question. If I presented you with a deal like this and you had the capital, the down payment to do it, would you do it? If you're hesitating, then you need more education on what makes sense to you. And you need more education on what goals you want to accomplish with real estate. Is it cash flow? Are you looking to be a flipper and just make quick money all the time? Are you looking to be a big developer and make huge windfall profits? Or are you looking to build a portfolio with properties like this that give you income over a period of time? If you don't know the answer to that question, you'll never find the right property. This is how you analyze properties in today's market. I'm showing you relevant expenses for 2024 and 2025, new rents, new rules, and we picked a property that meets the expectations of today's discerning tenant. Tenants are happy, we're happy, everyone's getting paid, mortgage gets paid, and our goals get accomplished. Friends, in summary, if you have a tool like I'm showing you right here, and by the way, if you send me an email through the description, my contact information is there. I'll give you a free copy of this tool. Even if you don't know how to use this thing and you don't know how to analyze properties professionally, you're not experienced with it, if you can at least input the basic information of income and expense, and you scroll all the way down to the bottom and you come to this spot that says cap rate. If that number is anywhere close to 6% or above, you probably have a good performing property, okay? And if you need help analyzing the rest, you need to have professionals around you, being a friend who knows and understands investment properties, but preferably an investor-focused realtor who knows how to get it done. And that being said, if you need one of those, we can help you. That's what we do. I want you to contact me, or even if you don't want to contact me right away, if you want to learn about me, check me out, see who I am, see if I'm an honest person, see how long I've been around, no problem, read my book. I wrote a book just for you so you can understand where my thoughts come from, how I invest, what my thesis is, and how I help other investors accomplish the same type of goals. My 56-page ebook is downloadable right in the description right here.